All right, so on to the iTrend, very bullish. So the iTrend is one of the newer strategies. Like Josh had mentioned, this is a newer one that we've put into place. It's in the actual system as a sole signal itself. So you can do iTrend, you can do iTrend very bullish, iTrend bullish, and then I'm not sure the other one. I have to look at it and see. But there's 3 selections you can do
Bearish.
for the bearish. Okay, there you go. So this is the iTrend very bullish. So as that signal speaks, pretty much a trend is defined as a general direction in which something is developing or changing. And then very bullish, as it says, is characterized by the movement in a stock price that has been going up or higher in price and expected to continue higher in price and probably faster as well. So this is the very bullish signal you're talking about. Within this iTrend signal, there's 2 signals that make up this one, and it's the DI histogram and it's the RSI. A lot of people probably know what RSI is, but not too sure what the DI histogram is. So I'm going to go through those in a second. The DI histogram uses a 13-day move that has crossed above 0 and is currently greater than 10. And the RSI is a 3-day RSI, and it has to be greater than 70 but less than 85. So a little narrow window there on the RSI to meet that signal. The theory is once both signals have been triggered on the same trading day, the bullish signal is active, and the combination of those 2 symbols will, those 2 signals, help the stock kind of push a bit higher. And we just give the signals below, which I've already talked about those. So the DI histogram is part of the ADX, or the average directional index signal, and it's basically used to validate the occurrence of a potential uptrend. Typically, you have a positive DI and a negative DI, and if the positive directional index is greater than the negative, then you're in a bullish uptrend. So that's where that above 0 and a positive 10 would come into play. And then when the positive DI is trending or moving up, and above the negative DI, that's when it's in the uptrend and the trend's getting stronger. However, if the positive DI is falling and trending below the negative DI, then the stock price is in a downtrend, and the downtrend should be getting stronger at that point. Again, a lot of these signals, some signals that I use quite a bit, I know I have some good information about, some that I don't use as often. But if I don't know too much about the signal, I do the old trusted Google search and just try to find a couple different articles that seem similar and are reputable, and I just read that information and try to get a good feel for what that signal is talking about there. We also have a good help button within the actual platform that you can use. So anytime you're in the platform and you have a question either on a signal or somehow to make an adjustment or any particular selection within the platform, you can always click on that help button and it should lead you in the right direction. So here's an example of what a DI histogram would look like on the Delphian platform on a chart. So you can see this is using Twitter, and it's using it on January 7th, 2020 of this year. And you can see the DI was 10.25. So we're looking at this particular bump up right here, and I can't hover over it because this chart's static. It's not within the platform, but this signal right here is at 10.25. And so this is where you're looking at. So, possibly around in this area somewhere, we might have got another trigger, but the RSI might not have matched the particular indicators, like the between 70 and 85, so it didn't get a signal at that point. So now we're talking about RSI. RSI is a momentum oscillator that measures the speed and change of price movements. It goes between 0 and 100. Typically, people use 14-day RSI, and the standard is a stock's going to be overbought at 70, and it's going to be oversold when it hits 30. So a lot of people will use those 2 points to maybe if the stock breaks above 30 and closes above a 30 RSI for 14 days, they might use that as a buy trigger. And inversely, on the sell side, if it closes below 70 and it's falling, they might use that as a sell signal. A lot of different ways you could use the RSI, but that's what's great about the platform. You can test those different theories and see if something holds water or not. So, alone, each one might be somewhat subjective, if you will, but putting those 2 together, that's when we're getting this iTrend very bullish signal. And I think that's where it puts some validity behind, buying an RSI when it is above 70, which is somewhat not the norm, out in the market if you're asking traders or other people. So we can see on this chart, I'm showing you Twitter again on 1/7. Here's 1.7, the RSI, 72.0283. So you can see this is our RSI just barely above that red line, which is the 70. So again, you can see here a 30 and a 70 is mapped out on the chart when we pull in the RSI, because that's just the standard. If I look at an example of that Twitter stock, so on 1.7, Twitter came up as the iTrend Very Bullish Delphian study under high probabilities. So we can see Twitter, again, we could do various things like we wanted to if we wanted to run a back test or look at a chart. Here we can verify the numbers. You can see the DI histogram 13-day above 10, 10.25. And then we can also see that the RSI 3-day is between the 70 and 85. I haven't used this much. I was just looking at that as I was speaking. The previous day histogram, 0.47. So remember, we wanted it to break above 0 and be above 10. And that's exactly what we have here. It was below 0, broke above it, and then closed above 10. So that's why those two came together. Again, clicking on this little X here, I can look at my trade. So on that day, on 1.7, I believe, I would have bought the $36 call on Twitter for the March 20 expiration at 1.18. So this is where it comes into play, like what Josh was speaking about before on, trying to keep your risk amount the same. This stock here, we're looking at a fairly low risk, $118, and you're looking to make a 25% profit. So, you're looking to make roughly what, 27, 28 bucks off the trade per contract. So if you typically trade an Amazon option that's worth $2,000 and that's risk that's comfortable to you, you might want to trade 20 of these contracts or 18 of these contracts, and then that will make that comparison between Twitter and Amazon, that much better. If you just trade one Amazon and one Twitter, the variance in the prices and then your profits are going to be so hugely different that a loss on the Amazon and then a profit on the Twitter, they just won't compare. Here's your trade results, Twitter long call results. So on 1.7, you can see we entered in the trade. The stock was at 32.54. We bought the March 20 $36 call at $1.18. We had the sell order to get out at a 25% profit. On 1.16, it sold the long call when Twitter went up to 34.19, and you can see we sold it at $1.55. Something I didn't really speak about earlier, not really applicable to this scenario here, but when you're doing other types of trades, whether it be like earnings or some other type of back test, you have your implied volatility here on the options, and then you also have your delta and some of your other Greeks that you can look at there as well. Bull call results, we can see this is for your bull call, same entry date. We're looking at a cost of 308 bucks. You can see we bought the $28 call and then sold the 33. The standard that we have set up in here, and I wasn't a big fan at first, but now I'm kind of coming to being one. You can see we're buying a $28 call and we're selling the $33 call with the stock currently at 32. So we're basically buying an in the money call and we're selling a call that's near at the money. And the reason that being is because you're getting a lot more premium essentially for selling the option that's at the money or at the market price. So you are skewing your cost versus your profit. You're skewing that a little bit because you're paying 308 and your max profit, like we said here, is like we're looking at is 192. A lot more of the bullish option traders are going to want that risk to reward to be somewhat reversed. But what I like about a trade setup like that with that bull call is if the stock moves sideways, or even if the stock moves down a little bit, I can still, or if the stock moves up, I can make money on the trade. Typically, the only real scenario that I'm losing the entire amount of money that I invested on this trade is if Twitter actually tanks and drops well below that $30 range. So, really I have three ways working in my favor versus one that I can actually lose at. So that seems to set up a higher probability type trade. We can see this one lasted until February 6th is when we got out of the trade. The stock actually jumped up, Twitter jumped up to 38.41. And we sold this. So we originally bought the spread for 308, and then we sold it actually for $1.70 plus 3 at our $1.70 profit. And you can see that relative to these prices here. The bull put, similar fashion that was mentioned before, risk to reward scenario, but doesn't take validity or take away from the trade at all. The bull put trades, I believe, are really great trades to utilize in your account as well. So 1/7, same entry date. You can see that we sold the $28 put and we bought the $26 put for protection. And then we can see on February 6th, we got out of the trade, for minimum amounts of money and was able to collect that $31 profit. So on a bull put spread, when you're selling a spread, the most you can make when you sell the spread is the credit you receive to sell it. So the most we can make on this trade is $33. So if you see a trade like this in the studies comes up and you're like, well, the most I can make is 33, obviously you have to use your judgment to say, well, that's not the best of credits that I'd want to receive, to actually place the trade and take on that risk. You could maybe make some of the adjustments within the strategy, but again, make sure you're testing it to make sure it works out with the right, win percentages and things like that for you. But, that being said, use your judgment on those. So we can see selling the spread, we closed it out for 31, or we closed it out for $2, so we're able to keep the $31 as profit. Strategy results, we're looking at the long call over time, $10,000 in profit, 1.81 profit factor, 81% win rate. Pretty nice, equity graph here. Took the dip again like everything did, kind of around that March timeframe, COVID, but it's kind of leveled out now. But you can see this nice slope that we have. So one of the goals that we have and that you should have too is if you see a chart like this, maybe it's time to try to make an adjustment to say, hey, can we make some type of trade adjustments, or is COVID just a one-off and this market should kind of resume? So those are things that you can think about and maybe a way to help that graph, that slope keep increasing instead of kind of flatlining. Bull call strategy, $25,000, 2.11 profit factor, 84% win rate. We can see here this big dip. And then our bull put, Josh had talked about that earlier. We got some of these dips well below. Sometimes those bull put strategies aren't going to be, the best, but I think in the long run, you can still work some profits in by using these strategies. And again, since they are risk defined, when you sell it, I kind of like those trades because you kind of know what you're getting into at that particular point. Any questions on that one? So that was basically the iTrend. I haven't seen any questions, so either everybody's asleep or I'm just doing a good job.
Yeah, no questions so far.
All right, so I'll move on to the next one then. Please feel free to ask questions, slow me down, or divert me to talk about something else if you're getting tired, because this is a lot of data to digest. So.